of the platforms that are out there today. My favorite brokerage firm, Thinkorswim, they have a platform that if I had that when I was trading on the floor, oh man, I'd be one happy camper. But the fact of the matter is today, you have the best access to the best tools and the best trading platforms that anybody's ever had. That's an advantage. And some recent news has created additional benefits to using options. Number one, the NASDAQ, the big, powerful, mighty NASDAQ, is now in the option game. They're listing options on their exchanges. They bought the Philadelphia Stock Exchange, which had a good option floor. So when the NASDAQ, the big, powerful NASDAQ, the exchange that went toe-to-toe with the New York Stock Exchange, fought a battle and won, decides that they want to get in the options game, you know options are here, and they're for real, and they're staying. Options are now being traded in pennies. Remember what trading in pennies did for you in the stock market? It tightened up the market. It provided smaller spreads, thus lesser costs for you to get in and out. And now even the SEC's hopped on board. They're starting to make changes in the margin requirements that you need when you use options. They're making options more affordable and easier for the individual investor to use. Why? Because of the hedging power. Because of the hedging power. The reason that options were truly developed originally. The SEC even sees this now. And they're saying, look, these options remove risk from portfolios. They should be margined, accordingly. And they're now starting to margin options more appropriately. And they're going to continue to do that in the future. They're not there yet. They're not margining properly yet, but they're getting there. There have been vast improvements there. So with all this news information out on options, as an individual investor, you have to sit back and say, hey, something's going on here, something that me as an individual investor managing my own money needs to find out more about. Options have several advantages over stock. Number one is cost efficiency, and that's really important right now, really important. Many of you have had your fund managers lose a considerable portion of your portfolio for you. You don't have as much money as you used to have. And the problem is that when you're looking at your portfolio, you're saying it used to be 200,000, it's now 100,000. I've got to get that 100,000 back. But how are you going to do it? You all know it takes money to make money, but not when using options, because options have a cost efficiency advantage over stocks. Little example. Say if I bought 1,000 shares of eBay at $41.75, I would wind up spending $41,750 to maintain that position. However, at the same time that I looked at eBay, I went out and looked at an option a year out. I looked to buy 10 of the January 2008 30 strike calls, and at the time they were trading for $16.30. Now, why am I buying 10? Because each option contract is worth what? 100 shares. 10 contracts would be worth 1,000 shares. So what I've done is I've balanced the equation here. So instead of buying 1,000 shares for $41.75, costing me $41,750, I'm going to buy 10 January 2008 30 strike calls at a cost of $16.30 per share per contract. That right there is a 60% discount. Why? Very simple. 10 contracts times 100 shares per contract times $16.30 gives me $16,300. I'm going to get to control 1,000 shares of eBay for a 60% discount. That is cost efficiency. being able to invest in, such a discounted fashion is so incredibly important for more than one reason. Like I said before, in this market environment where so many people have lost so much money, you really need to be able to have money to trade. And when you have lesser, you look for something to make it act like more, and options can do that for you. The other thing is what about when you're retiring? Remember, when you're retiring and you start drawing down on that nest egg. When you start drawing down, your account becomes smaller. And because it's smaller, it doesn't make as much. In theory, you could wind up outliving your money. But if you were using options and using the power of the leverage of the option, then your account, although smaller, can still trade like it was bigger. So that discounting, that cost efficiency is incredibly important to an individual investor in many ways. Now, some people say, but Ron, see, I like getting my dividends. And options, you don't get your dividends. I like my dividends. Well, hold on for a second. Let's think about this for just a minute. We can actually create our own dividend. Think about this. When we did that eBay example, when we bought the stock, we spent $41,750. Instead, we bought options and only spent $16,300. That means the person who bought the stock spent $25,450 more than the person who bought the option. So the person who bought the option is sitting on $25,450 of cash in their account. And that cash in their account is what? Collecting interest. And at market rates at 3%, $25,000 cash savings staying in the account at 3% is $763 per year. So in essence, you've created a 76-cent yearly dividend. If you break that down to quarters, you've collected a 19-cent quarterly dividend. Did you know at the time of this example, eBay was only paying a 3-cent quarterly dividend? We call this a synthetic dividend. Instead of getting the dividend, we're collecting interest on the cash that we didn't have to put out to own the stock. And that almost always outperforms whatever dividend a company's paying. It's a safer alternative to shorting stock. You have to remember that it's very difficult to short stock in any environment. Margin requirements, rules and regulations. And if you can't short a stock, then you can't make money in a down market. Well, guess what? I want to make money in a down market. So what do? I buy puts. That's right. Remember, the put gave us the right to sell. If we have the right to sell something at a certain price in the future, and that something is lower in price, then our right to sell it at a higher price will produce a profit for us. We could take advantage of things going down. And in the market we're in, especially that last year and a half, from 2007, say fall of 2007 to now, which is spring of 2009, the ability to make money on the way down has been critical. Lots of problems with shorting stock. Like I said, margin requirement. You have to be able to finance in cash 50% of the value of the stock you short. That could be pretty expensive, especially if we're looking at an Apple or a Google. SEC rules. There are some SEC rules stating that you can't short stocks in certain types of account. But there's no account that you can't buy a put in. Brokerage rules. Just because the SEC might let you do something doesn't mean your broker has to let you do something. And many brokers don't allow customers to short stocks. And finally, the last barrier to shorting stocks is investor psychology. Investors like buying things. Well, this is beautiful. I can buy a put which makes me